Can the Reliance Nippon Life Premier Wealth Insurance Plan let you achieve financial freedom without compromising protection? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So this is a unit-linked non-participating individual life insurance plan, and some of the key features of the policy are: you can choose from flexible premium payment options such as single pay, limited pay or regular pay. You can also enjoy wealth boosters credited annually from the 8th policy year onwards, and you can access partial withdrawals to meet emergency fund needs after 5 policy years, and you can even combine wealth management and value creation in a single plan. You can switch seamlessly between active and auto-managed investment styles. You can customize your insurance coverage level to suit your individual requirements and also avail tax benefits as per the prevailing tax laws. Now let's take a look at the benefits of this policy. So first is the death benefit, which in the unfortunate event of death of the policyholder during the policy term, then the nominee or the legal heir will get either of these 3 options, whichever is highest at the date of death. That will be given as a death benefit to the nominee or the legal heir. In addition to this, if the policyholder has a top-up fund value, then out of the another 3 options like top-up sum assured or top-up fund value or 105% of the top-up premium paid, out of those options, whichever is highest at the date of death, that will also be given additionally as a death benefit. This is the death benefit. Now if you take a look at the maturity benefit, you will find that on survival of the policyholder till the end of the policy term, that is when the policy matures, the total fund value, which is the sum of your base fund value and top-up fund value, will be payable as a maturity benefit. You can receive the maturity benefit as a lump sum or as a structured payout using the settlement option. There is another benefit called wealth boosters, which in the form of additional units will be added to your policy every policy year starting from the end of the 8th policy year. So each wealth booster will be a percentage of your average daily fund value in the preceding 12 months of the base plan in the same policy year, and will be 0.30% per annum for regular or limited pay policies and 0.50% per annum for single pay policies. So these are the benefits available under this plan. Now let us take a look at the fund options available under this policy. The fund options available are Life Large Cap Fund, Life Equity Fund 3, Life Pure Equity Fund, Make in India Fund, Life Balanced Fund 1, Life Corporate Bond Fund 1, Life Money Market Fund 1. Now all these funds are categorized based on how much allocation of percentage they have to asset classes like equities, debt, money market, and also according to the risk profile they possess, which can range from low to high. Now let's take a look at the investment strategies that are available under this plan. So there are 4 investment strategies available, namely number 1 self-managed option, number 2 auto-managed option, number 3 target maturity option, number 4 life stage option, and whichever investment strategy you find suitable to your financial requirements and needs, you can choose that strategy. Now let's take a look at the various charges that we need to pay under this policy. So first of all, there is something called premium allocation charge, which is a percentage of your premium which will be deducted from the premium amount at the time of premium payment, and the balance premium will be then used to allocate units in the chosen investment funds thereafter, and this will differ based on the policy here. The percentage will differ. Now another charge is the policy administration charge. So this is a monthly charge for regular or limited pay, which will be deducted at a rate of 300 rupees at the start of every policy month, and for monthly administration charge, this is deducted at the start of every policy month. Another charge is the mortality charge, which is deducted for providing you with life cover, and this charges will vary depending on the amount of your life insurance cover, like attained age, occupation, health of the policyholder, and fund value, so on. Another charge is the fund management charge, which is charged for managing your fund. So the charges will depend on the risk profile your fund has. So the lower the risk, the lower the charges, higher the risk, higher the charges, like that. So the charges will differ from 0.50% to 1.35%. There are also partial withdrawal charges. So there are two partial withdrawals in a policy year which are free, but a partial withdrawal charge of 100 rupees will be deducted from the fund withdrawn on every extra partial withdrawal. Another charge is the discontinuance charge, which depends on the year of discontinuance, premium amount and premium paying term. There are no discontinuance charges from the fifth policy year onwards. There are also switching charges. So in this policy there are 52 free switches during any policy year and 4 free switches per year during the settlement period. So subsequent switches, if any, will have a fixed charge of 100 rupees per switch. What we need to understand from these charges are, generally ULIPs come with additional costs such as policy administration charge, as you can see in this policy, like premium allocation charge and partial withdrawal charge. These expenses increase an investor's overall cost and are not typically associated with other market linked investment products. So over time what will happen is these charges can considerably erode your returns, impacting your wealth accumulation potential. So you need to understand this as a drawback as well. Now let us take a look at the advantages and disadvantages of investing in this policy. So the advantages are, you can enhance your base policy with optional riders for added benefits. You can also make adjustments such as increasing or decreasing the base premium, changing the sum assured or modifying investment options. You can also contribute additional funds through top-up premiums and access partial withdrawals from the base fund value after 5 policy year or upon the policyholder turning 18, whichever comes later. You can also utilize the self-managed option to switch between funds and redirect premiums as needed, and you have the option to receive maturity benefits either as a lump sum or through structured payouts via the settlement option. So these are some of the advantages. The disadvantage are, this plan does not provide you with a loan facility and the liquidity in this plan is limited during the initial 5 policy years, and the premiums you invested are also only invested after deducting applicable charges. So these are some of the drawbacks that you need to consider and thoroughly review before making a decision to invest in it. Now, as we have a basic understanding of this policy, let us now assess the performance of this policy, because estimating potential return help compare this plan with other investment options to see whether this is a good option or not. So let us now calculate the internal rate of return IRR based on the figures from the policy brochure. So just for an example, let us assume that a 35-year-old male purchases this policy with a sum assured of 25 lakhs. The policy term and premium payment term are both 20 years with an annual premium of 2.5 lakhs. So upon regular premium payments, the maturity benefit will be the fund value. So here what we are going to do is, we are going to calculate the maturity benefit based on two assumed potential rate of return like 4% and 8% to indicate both worst and best case scenario. These returns are not guaranteed, nor do they define the upper or lower limits of the returns you can get from this policy. This is just to show you or give you an idea of how this policy can perform in a worst and best case scenario. So now at 4% return scenario, which is the worst case scenario, the fund value is 63.42 lakhs, yielding you an IRR of 2.21%. So effectively offering no real value addition, because 2.21% is lower than a savings bank account rate of interest. So at an 8% return scenario, which is the best case scenario, the fund value rises to 99.32 lakhs with an IRR of 6.16% as per the plan's maturity calculator. As you can see, 6.16% is also something comparable to a debt instrument. But here we are investing so much of time and taking the kind of risk in this policy because it is a market linked investment, only to get a return which is comparable to a debt instrument, wherein debt instrument can even give you guaranteed returns. Here we are taking the risk of a non-guaranteed return only because in long term we believe that it will give us good return. But here the return from this policy falls short when compared to other market linked investments. So while the plan does carry significant risk, its returns are comparable to lower risk debt instruments, making the risk unjustifiable. So this mismatch in risk and return undermines the plan value, making it an unsuitable choice for achieving your financial goals. So as from this analysis, we can understand that investing in this policy can disrupt our financial strategy rather than support it, because the plan fails short on supporting long-term wealth accumulation and offers a relatively low sum assured. So what we are going to do is we are going to take an alternative approach where instead of investing in a ULIP plan like this, we are going to separate the insurance and investment components and invest in it separately. So let's compare the returns of such an approach using the same previous example as a parameter for a fair comparison. So for life cover purpose, we have opted for a pure term life insurance policy with a sum assured of 25 lakhs which costs 13,200 annually for a 20-year policy term. So by contrast, the Reliance policy requires an annual premium of 2.5 lakhs. Here only 13,200. So opting for the term insurance policy saves us 2,36,800 rupees annually, which can be invested to grow your wealth. So investment options should align with your risk appetite. Low risk investors can choose debt instruments like PPF. High risk investor may opt for equity instruments like ELSs. Here we have considered both. Though the annual PPF investment limit is 1.5 lakhs, this example assumes the full surplus is invested. Just to give you a better idea, so over 20 years the pre-tax maturity value will be 1.05 crore with an IRR of 6.64%. This matches the returns from the 8% scenario of the Reliance policy, even a little bit slightly higher than that, despite PPF being a low risk debt instrument. So investing the annual surplus in ELSs results in a pre-tax value of 1.91 crore. So after accounting for capital gains tax, the maturity value is 1.73 crore with a post-tax IRR of 10.78%. So this strategy provides a significantly larger corpus, outperforming inflation and better supporting life goals. By separating insurance and investment, each component here delivers optimal results. In contrast, the Reliance policy offered low risk adjusted returns and inadequate coverage, making it a less effective choice for achieving financial objectives. So what is the final verdict on this policy? Is investing in the Reliance Nippon Life Premier Wealth Insurance Plan worth it or not? So this plan aims to combine market linked savings with life insurance coverage. However, it struggles to deliver effectively on both fronts. Written analysis indicates that the plan rarely generates the corpus needed to meet life goals, primarily due to high charges that diminish the investment amount and negatively impact returns. The insurance coverage offered here is insufficient, failing to provide a robust safety net for unexpected financial events, and it also has a high agent commission. So as a result, this plan falls short on all fronts, making it an unworthy choice for the associated risk involved. So what can you do instead? A more effective approach involves choosing a pure term life insurance policy for comprehensive coverage and building a diversified investment portfolio to achieve wealth accumulation. So this strategy eliminates the drawbacks of combining insurance and investment, providing a clearer path to fulfill your financial goals and aspirations.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.